All right, let's talk about the economy. Because, let's be honest, it's pretty confusing right now. You hear one expert say we're booming, and the next one says we're heading for a cliff. So which is it? Today, we're going to dig into both stories and try to figure out what's really going on.
So this is the big one, right? This is the question everyone is asking. On one side, you've got all this talk about incredible growth and productivity. But on the other, you hear these serious warnings about deficits and long-term risks. How can both of these things be true at the same time? Let's unpack it.
So here's how we're going to break this down. We'll start with the two big, competing stories out there. First, the warning signs. Then, the case for a major boom. After that, we're going to talk about why forecasting is so tricky in the first place and look at a new way of seeing things. And then finally, what all of this actually means for you and me.
All right, let's set the stage here. To really get what's happening, you have to understand both sides of this argument. Each one uses real data to predict where we're headed, but wow, they end up in completely different places. We're going to start with the more cautious take, the one that raises some pretty serious flags about the road we're on.
Okay, so this first perspective basically argues that some government policies, even with the best intentions, might be setting us up for trouble down the line. It's really a story about the tension between short-term help and long-term health. Let me show you what I mean.
So take healthcare subsidies. You extend them and boom, you get immediate relief for millions of families. The premiums don't spike, which is a huge deal. But the argument here is that this relief comes with a price tag. It means more federal spending, and that adds to the national deficit.
And it's a similar kind of story when we talk about new regulations. Of course, the long-term goals, like protecting the environment or workers, are incredibly important. But this viewpoint points out that in the short term, these rules can really drive up costs for businesses, and that could mean slower job growth and smaller paychecks, especially in certain industries.
We see this exact same trade-off with tariffs. Get rid of them, and hey, prices for everyday stuff go down. We're talking maybe $1,000 or more back in the average family's pocket each year. Sounds great, right? But the flip side is, that's less money coming into the government, which could make that deficit problem even bigger.
So you see the picture this paints, right? You put it all together, more spending, less revenue, and you get a wider deficit. And that could set off a kind of domino effect. Higher interest rates, businesses investing less, and over time, slower wage growth that could actually hurt our standard of living. It's a forecast of long-term pain for short-term gain.
But that is just one side of the coin. Now let's flip it and look at a completely different and way more optimistic vision for the economy. This perspective says, hey, if you just look at the latest numbers, you'll see an economy that isn't just surviving, it's thriving.
First off, just look at that growth number, 4.4%. To put that into perspective, for years we were told the new normal was going to be like 2 or 2.5%. This is way, way above that. It tells you something really powerful is kicking into gear.
And what's fueling that? This right here. A massive, almost 5% jump in labor productivity. All that means is that workers are getting way more efficient, producing more stuff in less time. And that is the secret sauce for strong economic growth that doesn't just send inflation through the roof.
Now, you're probably thinking, wait, what about that deficit you just made me worry about? Well, check this out. The latest data shows it's actually getting smaller. It's down 17% from the year before. And the reason is pretty simple. A bigger, more productive economy means more tax revenue for the government.
So what this all points to is something economists get really excited about called a productivity shock. It's just a fancy term for a huge leap in efficiency that basically rewrites the old rules. It means you can have it all: strong growth, rising wages, and keep inflation in check. In this view, we are absolutely headed for the best of all possible worlds.
So we've got two completely opposite stories, and both seem to have the data to back them up. One says, danger ahead. The other says, full steam ahead. So how can that be? This leads us to a much deeper question. What if the argument isn't really about the data, but about the tools we're using to see the future?
And this is where things get really, really interesting. Maybe the reason we have these two clashing stories is because our whole way of predicting the future is just broken. I mean, think about it. We might be trying to navigate this super complex 21st century economy using tools that belong in the 20th.
I mean, just look at this. This is wild. 60% of finance pros, the people whose job it is to get this right, admit that their own process, manually punching numbers into spreadsheets, leads to critical errors. This isn't some small little problem. It's a huge crack in the very foundation of how we make big economic decisions.
And let's be real for a second. Spreadsheets are great for a lot of things, but they are not forecasting tools. You've got human error, they're totally static in a world that changes by the second, and they make us rely way too much on the past. And when the data runs out, we fall back on gut feel, which is really just a nice way of saying we're guessing.
And this isn't just some theory, you know. It has massive real-world consequences. Look at Aston Martin. The carmaker had to slash its production goals because of supply chain issues it just didn't see coming. And the result? Its stock price tanked by 28%. Now just imagine that kind of forecasting error, but for the entire US economy. The stakes are huge.
So if the old way is broken, what do? Well, this is where AI steps into the picture. More and more, the answer is AI-driven predictive analytics, which gives us a chance to see what's coming with a clarity that was just impossible before. And this isn't just a small upgrade. AI completely flips the script. It's not static. It's always learning from new data. It can juggle a level of complexity that would make a human's head spin. It lets you run 1,000 what-if scenarios in a heartbeat. And, maybe most importantly, it takes out all that risky manual error. Honestly, this is the best way to think about it. The old way of forecasting is like trying to drive forward by looking only in the rearview mirror. You only see where you've been. AI is like a GPS for your business or for the economy. It's using real-time data to show you a map of the road ahead.
Okay, so let's bring this all home. We started with two totally different stories about where the economy is going. One gloomy, one glowing. And now we have this third, really powerful idea, that our very ability to see what's coming is in the middle of a revolution.
And this gets us to the most crucial point of all. The reason for this huge debate, this fight between the boom and gloomers, might be that both sides are using broken tools. They're looking at the same world through a cracked crystal ball. The real story might not be about deficits or productivity. The real story is that our ability to predict anything is fundamentally changing, right now.
And that leaves us with one last really big question to chew on. As we switch from driving with the rearview mirror to using a GPS, it's not just going to change business. Our entire public conversation about the economy, about policy, about our shared future is going to have to change too. The question isn't just what's going to happen next, it's how do we even start to talk about it in this new world?